Welcome to the weekly update, where I'll go over the action in the market for the week of September 9th through the 13th, and then we'll see how things look for the week of September 16th through the 20th. Very interesting week this past week. A week ago when I did this video, we were turning quite decidedly negative, especially on the daily charts. We were still hanging in there pretty good here on the weekly charts. Well, about halfway through the week on September 11th, we saw a reversal. And that pretty much carried us through into Friday and has turned things back on the daily charts to looking more positive. So we have the Fed coming out this week. They're going to be cutting rates. We don't know how much, and there's going to be the press conference. The market's going to hang on every word that Chairperson Powell says. And we're also coming into, especially in the latter part of September, a weak seasonal time. Now, it could be different this time, and we don't know how things are actually going to play out. Right now, things are looking pretty good, but they've looked good in early September to mid-September before, only to see some weakness, especially during an election year, going into the latter part of September and into October. We just look at the charts. We don't try to guess what's going to happen or come up with our own scenarios to what we think will happen. We can only look at what the charts are telling us right now, and then just conclude what we see and then readjust things on an as-needed basis. Okay, before I get going into that, I do a video each day, and that's where I really do my commentary and analysis. Now, I know my videos are longer because to really get to know what's going on in the market, you can't just look at a stock or even one index. You have to look at everything together because it's all interconnected to each other. And I go through what I see happening on a daily basis in the daily videos. And that's the real foundation of the analysis and commentary that I do. There's a PDF below this video, and every video that I post, you can download the slides and the charts. Some folks find that helpful. Also, every day I update pivot points on the YouTube community tab. I can't do this on Rumble. There are pivot points that last the whole month. And then there are pivot points that change every day, and those can be really critical and helpful. I do have a private Facebook group, not really active, pretty much only me posting whenever I upload a video. If you want to join, you're not necessarily interested in the program that I have, please feel free to do that. And we can have some back and forth. I'll talk to anybody because I'm an educator. So if that is of interest to you and you belong to Facebook, please feel free to do that. And I go through, and it's like they took Labor Day off or something the weekend, but now I've been deleting some crazy comments on Rumble, not so much on YouTube, but I like legitimate comments on there. I make the garbage comments and the spam comments and the people that supposedly are social media experts. I delete those. And if they would watch the videos like they say they do when they send me this copied and paste comment, they would know my email address. They could contact me that way, and they would know that I delete those comments. But all right, there we go. And then I do post on YouTube and Rumble, and here's the link to that. It's also in the description. There's a thing called the SPXInvesting Program. It's up, it's going. There's a website that you can get to by a link in the description. You can email me if you want to talk about it, if you want to set up a time on Zoom or Skype or whatever. There's also another link that'll take you to a video that talks about what I'm offering. It's free for right now. I will be locking that down at some point. Now, I've delayed locking it down mainly due to a trip that is happening in this week from September 17th through October 1st. I'm supposed to go on a trip, and I wanted to wait until after that trip until I actually kind of start to lock things down on the website. So it's easy to access right now. If you are a member, you get immediate access to the videos as they're prepared, uploaded, and I make them available on the website right away, where I set a timer for them to go public on YouTube and on Rumble, both with the daily and the weekly videos. And this just shows you in graphical form. The daily video is the real hub of what I do, and all the other videos, including this one around the outside, they're meant to feed into the daily video. All right, let's go back and talk about this week's session. We were up 4.02%. Now, the week before, we were down over 4%. We didn't quite get all of that back, but did a pretty good job. And we saw a pretty massive reversal. And I'll show you the intraday chart here in a moment. We were above average with volume for the week. Now, a little bit of a concern is we went up not only on Wednesday, but we also went up on Thursday and Friday, and that was below average with volume. That's a little bit of a concern. But when you take the whole week together, we were above average. And we are looking more positive now, and we'll go through the charts here in just a moment. We were a week ago full-blown negative on the daily charts. Well, after Wednesday, we saw some improving things happening as the week played out. And then we switched over and we're full-blown positive for right now. We'll have to see where we end up going forward from here. There's been so much anticipation for this rate cut, and the Fed has pretty much announced what they're going to do. We just don't know by how much. And I'll show you the charts. It's 50-50 right now. That's how indecisive the market is currently. And we had some inflation data this past week, CPI, PPI. And that seemed, well, at first, the CPI reaction was negative. That's before the market opened. It was the futures that were trading. But then we came right back up to unchanged. That gave us a flat open. And then we just dove. That was on Wednesday. And then we hit a support level and bounced up out of that. And the rest of Wednesday, Thursday, and Friday saw a really nice bounce. We want to keep an eye on the geopolitical things going on. In fact, I'm potentially going into one of these geopolitical concerns right now. My intentions are to do the weekly video next week and the daily videos each day. But I don't know how my internet is going to be. I don't know much, okay, other than my intentions are to keep doing the daily and weekly videos. So if you like these videos and you've grown accustomed to watching them, look for those. If for some reason they're not there, and the nice thing is from where I'm at right now to where I'm going, there's no time change. So I can stick with pretty much the same schedule. If you're used to seeing videos at a certain time and they're not there on either YouTube or Rumble, that means I'm not able, for a million different reasons, to do those videos. And we're not really dealing with earnings season right now. And then this past week, I did a video that I posted on the website about the recession and where do we stand with all of that. I show charts that suggest maybe we're not going to go into a recession. And then I go through other charts that say, this is looking like we could go into a recession. And those are things that we're keeping an eye on. Instead of listening to everybody else and everybody has their opinions and reaches their conclusions, we look at data, the best data. Okay, it might be manipulated data, but it's what the market uses. And so that's how we make our decisions. And then we're going to be getting some Fed speak this week. There'll be the announcement that the Fed makes. There'll be the press conference after that. And that could really move the markets one way or the other. All right, as far as our trend, we're still positive. The green line's coming down, but it hasn't crossed above the red line. I'll show you that chart here in just a moment. And some bullet points just to go through here. We saw a real rebound after the previous week where it was pretty down and we were looking pretty negative because the mega caps and semiconductors were weak. Well, this week, partway into Wednesday, the mega caps and semiconductors kicked into gear and helped everything to go higher. Then CPI came out on Wednesday, and it was initially a negative reaction. We dove down with the futures, came back up. We dove after the market opened and then bounced up out of that. We went all the way down in the cash market after the market opened to 54.02, and it led to a significant bounce, which lasted for the rest of the week. I'll show you an intraday chart of that. And then the other economic data that came out, we had PPI, we had weekly jobless claims, and assortment of other reports. This is going with the idea that, all right, the Fed's going to cut rates, but it's not because the economy is falling apart. It's to try to stimulate things, and that inflation has been coming down. And that's more positive. You know, they say once the Fed starts cutting rates, stocks are going to crash, and that may happen. But you have to look at the context as to why is the Fed coming in and cutting rates. Right now, it's not because of some bad event. It's not because things are falling apart necessarily. It might be on a personal level, but remember, there's the economy that applies to you and your life personally, and then there's the stock market economy, and they're not always all that connected to each other. The market is figuring on a soft landing right now, which means we're not going to go into a recession. That could, of course, change, but the market's been stuck on that for a long time. And then I'll show you the charts to back that up as well. And that's going to really produce some problems if it looks like the economy is really falling apart. At the beginning of August, we had that weak employment report. Market just freaked out. And then we had that big down day on August 5th. That was kind of over the weekend, and it bled over into what was happening in Japan. Well, we're trying to avoid something like that now if we want to stay more positive with things. But there's also some weak seasonality that we could be dealing with as well. Interest rates were down. We're down at 3.65% with the 10-year yield, where a week ago we were at 3.71%. That's helping stocks. Lower interest rates do that. But you have to look at why are interest rates going down. And then the dollar was down as well. The market tends to like a weaker dollar. And that also gave some support to stocks. So for the week, the Dow ended up being up 2.6%. We had the NASDAQ up 6%. That's like a monster gain just within a week. Even the S&P was up 4%, where the week before it was, I think it was down 4.25% or so. And the small caps, now they haven't broken out of that range, but there's still this idea, lower interest rates, smaller companies, they don't have to pay as much as for interest, and they can put that money in towards their earnings, and that helps their stock price go up. It's kind of a general thing that happens there. Okay, and I bring up this chart every week because this is a long-term chart, and even though it hasn't been updated in a while, we're still in this area, if you can see my laser pointer here, where we're going down with inflation. And that's where we've been in this now for a year and a half or so, really since June of 2022. So a little bit over 2 years. That's when we topped out with the inflation rate, and we've been working our way lower since then. We're not at that 2% target yet, but the Fed is feeling more confident that we're eventually going to get there. That's why they're willing to come in and cut rates. Now they're wondering, okay, did they keep them higher for longer for too long? And is that going to end up damaging the economy? I mean, it's this constant juggling act that goes on, and everybody has an opinion about it. Well, the reason I keep showing this chart is even though we're in this declining CPI phase here with inflation, look at what happened after that. We don't know if it's going to play out that way, but we don't know it's not going to play out that way either. We just want to be aware of how things can change. We don't want to just blindly go into the market, not realizing, okay, what are the risks that we have to deal with right now? Then we're below that 4.02% with the 10-year yield, and that helps, especially the small caps, but any company that has to go out and borrow, because at 3.65, that's lower, and that helps. They can use that money to feed into their corporate earnings and profits and so forth. And this wasn't updated this week. It was updated a week ago. We want to keep an eye on this, but it's only updated once a month. These are folks that have been unemployed going on, starting their 7th month. It's 6 months have ended here. And it was going up a little bit since the last time we had this chart up. We want to watch the employment situation to see how that's doing. We can watch that every week with the jobless claims and the continuing claims. We can watch it every month with the employment situation report, and there's a number of different economic reports that are employment based that we can follow to try to get a handle around these things. And I mostly go over them in the daily videos. All right, and then the takeaway from this, I show this every week. This is just earnings going up from here. And that suggests that higher stock prices are still justified. Then we're looking at the equity fund flows, where we've seen some money coming out. Now, this is probably going to get updated here because we had saw a negative as we were going into the, what is this? September 24th of 2024. Okay, the 11th. Because the market was really seeing some pretty intense weakness a week ago. Well, it's probably going to change and go back up now that we're bouncing back higher, because there's this thing called FOMO, the fear of missing out. And everyone says, oh, the market's going to go in the toilet. It's going to go in the toilet. And then it goes up. It reverses midday. And now you got these people jumping in as fast as they can because they're afraid of missing out on some returns. Unfortunately, when you do things that way, you tend to arrive late to the party. So that's why we watch things on a daily basis and look at data, not just go what our emotions are telling us. And this, I'm not going to go through all of this, but this, if you want to pause this and look at it, the blue, this is money going into these areas, and the red is money coming out of these areas. And we're seeing money going into real estate right now. Real estate likes it when interest rates go down because across the board, it just makes it more attractive for real estate, even though prices for houses are still astronomical. Okay, and then lower bond yields and lower bank stocks is bearish. Okay, I've really been watching the financial sector. Now, it was also looking good back in 2007. And then we went into 2008 and had the great financial crisis. So these things can change quickly. There's a number of different yields that we're following right now. But right is at this time, and I'll show you later, the financial sector is doing okay for the time being. But it was also doing okay at this time back in 2007. So this is just an area that we want to keep an eye on. And then this goes back all the way to 2007. And it just tracks how we've been going higher here with a number of different things. This is a trend channel similar to the one that I show, and just different events that have happened along the way. And no, we don't go straight up. We don't go straight down. And if you're a perma bear, then you every time we start to go down just a little bit, you call that a crash, and you say, oh, we're just going down, down, down. And then we find some support somewhere along the way, and then we start to go back up. But if you're a perma bull, then markets don't go straight up or straight down. And that's what I do in my program. For long-term investors, I show you how to make money when we're going up and then protect yourself so that when we do go down, you're not going to lose anything. There are tools that you can use to take care of that. And I do a video each day talking about things that I recommend and suggest. And if that's of interest to you, even if you're only a long-term investor, this can really give you some peace of mind. I have long-term investments, but I implement what I teach in the course. So a week ago when we're heading lower and I've got some long-term positions, I'm not sweating it out because I know that the worst that can happen is I'm going to break even. And then when things turn around more positive, I know I'm going to benefit from the upside from those. So if that's of interest to you, please feel free to check out the program that I have. All right. The risk appetite level and momentum factors, it really came down here as we were going lower. It's probably going to bounce back up now as we've been seeing a bit of a recovery this past week. And then just one post here from FactSet. 40% of S&P 500 companies were talking about AI in their earnings calls. It dropped down a little bit from the previous quarter, but it's still very high. It's still the buzzword. It's what a lot of folks are talking about these days. Now, looking at the intraday chart, and we really want to go back to last Friday because we were just going in the toilet, something fierce here. And we came down and we set up a pretty good support level at this point. This also coincided with other support levels we were seeing. And then we tried to bounce back up here on Monday and Tuesday, but really couldn't get any solid momentum, even though we were higher. But these slight update or these updates that we saw really were helping our charts to improve. Well, then CPI came out. And the initial reaction, as I said, was negative before the market opened. And then we got back to unchanged. And then right when the market opened, boom, we just tanked again. But notice where we came down to. We went down to the area of the low set the previous Friday. That's when the smart money came in and just started buying like crazy and pushed us up. We saw a big reversal that day that carried over into Thursday, and not to the same degree, but also carried us into Friday as well. And this has really helped improve things. So for the week, and I just go through the 5 trading days here, you have the NASDAQ 100, all of the other indexes were up. Small caps were up pretty good, but everything across the board during the 5 trading days advanced. And then this looks at the indexes going back to the beginning of the year, where now you have the S&P in first place. Don't see that very often. The S&P is 503 stocks last time I counted. And there's growth in there like the Magnificent Seven, but there's also value stocks. There's also older stocks that have been around a long time. And so when we've been bouncing around like we have been lately, the S&P tends to hold up better. Well, when we're really screaming to the upside, it's the NASDAQ 100. And lately, it's even been the NASDAQ that's been outperforming the NASDAQ 100 as the mega caps have not seen the strength that we've been seeing before. But all of the indexes ended up being positive, and they're positive year to date right now. Looking at the sectors, where I look at this first, and we want to be a little aware of this here, because you notice, and I sort this from strongest to weakest, all the sectors were positive. Utilities, now you could look at this as a growth area because of all the changes they're trying to do, and everything's going to be electric based, and they're tearing down dams and going to electric vehicles and all that stuff. And that's going to produce the need for a lot more electricity. Okay. So that could be a growth thing, but this is usually a defensive area. And we saw utilities and other defensive areas really seeing some strength at the end of 2021, right before the market was getting ready to go down in 2022. So that's why we're watching these things. Industrials, this is more, it goes with the economy. Communication, this is a growth area. When this does well, we want to buy low and sell high. Materials, more or less with what's going on with the economy. But this is another concern. Staples, toilet paper, toothpaste. These are things that you have to have no matter what's going on in the economy. This tends to do better when the market is getting more defensive. You could make a case for real estate being more defensive too. Interest rates are going down. Usually in a growth environment, interest rates go up. But then discretionary, this is an area that is also heavily related to growth, like Tesla is in here. And so we need this to be doing better than it has been, because if you take tech, discretionary, and communication, those are the three big growth areas, where the defensive areas tend to be utilities, real estate, and healthcare. That's another real defensive area, and then staples. So, but all of them ended up being up this week. And then on the next slide, I rank these on a score from 0 to 100. The higher the score, the better looking that sector. See how utilities, real estate, and staples, they're all in the 90s right now. They're doing the best. That's causing us some concern. This is a defensive posture of the market. But we've been seeing this for a while now, and it really hasn't led to anything to this point. We don't know if it's going to lead to anything, but we want to be aware of this, that these are defensive areas. And if the market really starts to roll over, these areas, that'll kind of complete the story that we've been following. But we don't want to jump ahead of this. We want to watch things develop and then act accordingly. And that's why I really focus on the daily videos that I do. And then the weakest area right now is energy. It's been under a lot of pressure lately. Okay, so just for the 5 trading days, and I do this a little bit different. I don't compare them. You notice I have this blacked out here with the S&P 500. I'm just looking at another way of measuring these different sectors, where we had tech, discretionary, and communication up. Imagine that. These are the growth areas, where all of the other areas ended up underperforming. And then going back to the beginning of the year, we have utilities in first place and communications in second. Then all of the other sectors have been underperforming here. And then we look at a different chart. We look at a relative rotation graph. And up in the right-hand corner, these are the strongest areas. And when they're green, they're strong. When they're red, that's negative. And then in the lower left-hand corner, these are the areas that are weaker. Notice how real estate's really coming on strong and looking strong lately. Now, this goes back over the last year, but this also is taking into account what's happening right now. And we see utilities coming on strong. And we see where healthcare is coming on strong. And we see staples. See, these are defensive kind of areas here. The only one that you may make a case for is the financials. That's XLF. And then we're a little concerned here because we're seeing SLK, that's tech. XLC, that's communication. These are the growth areas. And here's XLY doing a little bit better here. That's discretionary. And some of the more economically sensitive areas are doing a little bit better. And then energy is really getting a lot weaker now. This shows that same thing in a little different format, showing how real estate, utilities, healthcare, financial, and staples, they're doing the best right now. And then we get into the blue area, that's more neutral, materials, industrials, and discretionary. And then the weaker areas are energy, tech, and communication. These, especially tech and communication, we want them to do better. And we like the discretionary has been doing a little bit better lately. All right, then we look at the indexes themselves and notice how utilities, they're strong. And so you got a lot of folks that are FOMOing because they're jumping into this. Oh, utilities are strong. Well, at some point the party's going to end, but we're not really sure when that's going to happen. But when you see people just throwing money in a particular area, usually they do this with tech, but There's been a lot of money going into utilities right now. And so maybe that's going to bring on some weakness. And we're seeing small caps looking a little bit better. But we've seen this before in 2024, only to get our hopes dashed. And then the areas, the S&P, the NASDAQ 100, and the S&P 100. These are the strong growth areas. These are what really drive the indexes higher. Notice how they're yellow and the NASDAQ 100 is still red. Yeah, we bounced up this past week, but this is going back over the last year. And we want to see these turn either blue or green and start to go back up this way, not be headed down in the other direction. Mid caps are showing some improvement as well. And so this is just another representation of how things are actually acting right now. And here's more like a spreadsheet showing how utilities and small caps are looking okay lately. And more neutral are the transports, the Dow Jones Composite, and the mid caps. Another kind of loosely neutral but more negative would be the S&P 100 and the S&P 500. And even with its bounce back up, we still are a little bit concerned about the NASDAQ 100. All right, as far as sentiment, and this is just more for fun here, this is a site called predictit.org. And a week ago, I think it was after the video that I did last week, they were neck and neck. In fact, Trump had actually gone ahead here, but then they had the debate, and the consensus was that he didn't do so well in that debate, and Harris did better. And so we're seeing it kind of chopping around here. And I follow this because people have to put real money on this rather than just answering some kind of a survey or a poll or something. All right, looking at sentiment right now, we're neutral. We're just a tick under 50 at 49. And this shows where we were getting better. We came down below 25 and we're starting to go back up with a dip along the way there. And then we dropped down back below 50. We were turning negative. Now, when we're extreme negative, then we start to look at going long or getting into positions buy low, sell high. When we get above 75, this is when we're looking to get out of those positions and possibly even go short in the market. Well, we were starting to come back down, but in the in-between time here, we go with what sentiment is doing, and it was turning more negative. Well, over the last couple of trading days, this has shown some improvement. Here's another sentiment indicator coming in pretty much at zero. You can't get really much more neutral than that. And then the active asset managers, these are folks too. They chase stocks. Now, this is about a week old with the data here. They're not really showing anything extreme. But with the up move that we saw this past week, it wouldn't be surprised if this really goes up the next time we see this chart. Here's that same chart showing how we came in at 71.93. The Ulcer index is still below its moving average. We're still above the moving average on the daily chart, showing that fear has been picking up. This was designed for mutual funds, and it's only based around closing prices. So, but I still find it kind of useful, and we use it in conjunction with our other indicators, like this one, the VIX, where we're dropping down below 20. We're declining with the line chart as well as the bar chart. As we've been going up, the VIX has been coming down, and we're getting more into those areas where we tend to see positive annualized returns. If we can stay there is the question. When we get above 20, that's where we see negative annualized returns. And then this is a seasonality chart where we don't know if it's going to play out this way, but we're not saying it won't play out this way either. Typically in September into October, that's when we see the VIX really going up. And that means stocks are going down. So that's something just to be aware of here. And we look at the VIX and a 3-month average of the VIX and do a ratio between the two, starting to tick back up just a little bit here. And then we're still going down, but ticking up a little bit. This is a very long-term moving average, 253 periods. That's really the number of trading days. I mean, sometimes it's less, more, but roughly 253. And so typically when this is going up, that's negative for stocks. When this is going down, that's positive for stocks. And then we look at another ratio between cash and the tech sector. Now, a week ago, this was starting to pop up, and that was giving us a little bit of a concern, but we were still below this Ichimoku cloud here. Now, with the reversal that we saw, we're starting to go down again for right now, and that's positive for tech. And we look at another sentiment gauge, looking at the bear to bull ratio here with the RIDEX mutual funds. They have mutual funds that go up when the market goes up. And they also have mutual funds that go up when the market goes down. You just have to be in the right one at the right time. And when this really spikes up, that means folks are getting a lot more bearish on things. But unfortunately, then we saw the reversal. Okay. And what often happens it's sad because the folks in here, they end up doing the exact wrong thing at the exact wrong time. They'd be better off doing the opposite of what their emotions are telling them to do instead of reacting to what's already happened. And then we look at the American Association of Individual Investors. They really dropped in the latest survey because we were weak a week ago. And we want to keep an eye on this. This is the spread between risky and not as risky bonds. Now, you're not really seeing all that much here on this chart. Where we see something that's giving us a little bit of a concern is the middle area of this next chart. Now, this is an inverted version of the chart we just looked at. And when this is going up, that means fear is decreasing. When this is going down, that means there's more fear. We have been going down, even though we ticked back up in Friday's session. We're keeping an eye on this. If this really starts to come down on this chart, that means fear is really increasing, and that could be some problems coming into the market. Then looking at the Chicago financial conditions, we're underneath the black line. So we're doing fine there. And then the latest reading from GDP is coming in at about 2.5% based on this. When they look at economists, they're coming in at about 2.33% to the upside and about 1.5%. The takeaway here is we're positive with GDP. And that feeds into this next one. The takeaway is that even the consensus or what Goldman Sachs thinks is going to happen, we're seeing positive GDP. Because a recession is one of the definitions is that we have negative GDP for back-to-back quarters. Well, we're not seeing even that being forecasted right now. So that's not a concern. This could change, but we're not seeing it right now. And then this is another way of looking at the GDP now forecasts. Again, the takeaway is that we're still positive across the board here. This was updated a week ago, causing some concern because we're getting a little bit above the red line here. But we won't have another update to this chart until the beginning of October when the next employment report comes out. Also, this hasn't been updated for a while. The smooth U.S. recession probabilities going up, but not up to the red line yet. The Bray Butters Keller leading index hasn't been updated for a while, coming down. When it was going up, that was causing us a concern. The only problem with this is a quarterly report, so the data can be quite delayed. Then looking at inflation, where we're pretty much flat right now and coming down just a little bit when we look at CPI and core CPI, because we had the report this week where we don't have PCE that will come out in a little while after this. Okay, this is kind of cool, isn't it? As of Friday's close, there's a 50-50 chance that they're going to cut rates 0.25% or 0.5%. That's as decisive as the market can be right now. And we're getting a little bit more locked into that. We're seeing the potential of a 50 basis point cut rise and just keeping it at 25 basis point lower. Now, we'll have to see how the market reacts to this. Because if they cut them not enough, the market might get mad over that, saying, how come you didn't cut them more? Inflation's under control. But if they cut them too much, there's going to be another crowd that says, does that mean the economy's falling apart? We better freak out over that. And then, so we just have to see how all this plays out. And looking ahead to the November meeting, there's a 50% chance that we're going to be at 4.5 to 4.75 at that time. There's still some folks that think we'll be at 4.75 to 5. And 27% of folks that think we're going to be at 4.25 to 4.5. And this is going to change a whole lot. And this is showing you how they are adjusting at these different levels. In the middle here, the dark blue, that's right now. And then we have a day ago, a week ago, and a month ago. All right, and then looking at the balance sheet for the Fed, where I always make a joke about this, where the line appears to be going down, but the number is positive. Only a government chart can do that. And then we look at the year over year, where we're pretty much not seeing any real big change here in the total assets on the Fed balance sheet. Not really seeing any big changes here with the overnight reverse repurchase agreements. We look for spikes up or spikes down, and then, okay, why is that happening? Nothing's really alarming at this point here. All right, so looking at the advanced decline line, we're above the moving average and going up based on price and volume. And we're seeing a pickup in volume on the daily charts, where volume is tending to outperform. Now, sometimes that can mean when volume is doing better than price, that can lead price higher. Not always, but as a general rule, it can. We were concerned a few weeks back when we were going up, but we saw price outperforming volume, and that we saw some declines after that. So that's why we look at the relationship between the two. Looking at the new highs, new lows, an internal measure here, a lot of new highs, not many new lows. But we're going down here with the 4-week moving average and still going down with the 10-week moving average. And it's not because we're seeing real weakness here. It just means we're seeing a trailing off of the new highs. The advanced decline ratio above 0 and going up, that's positive. And then this is a smart money indicator because it takes price and volume into account. We're still looking positive here. We went negative on the daily chart, and now we've switched back over to positive on the daily chart. So we're looking positive here on the weekly chart. Our trend, and I know there's a whole spaghetti mess over here of lines, but we're below the moving average, so that shows a weakening trend. But we're above 20, so that shows we're still trending. And then the green line, they're all on top of each other, but the green line, take my word for it here. The green line is at 24.99. The red line is at 24.36. So 99 is a little bit higher than 36. So we're still slightly positive here with this chart. Now we switched over negative on the daily chart, and now we're in the process of switching back positive on the daily charts. This is the Erin indicator where the green line, this shows buyers and they're decreasing, and we're seeing sellers decreasing too. And then the difference between the two is the oscillator down below, and we're above 0. So that's positive, but we're flat for right now. Mass index. Now we were working off of a mass index signal on the daily charts, and I don't know how legitimate that is because that got signaled and then took a week to week and a half, maybe even 2 weeks before we really saw a decline after that. Well, this is interesting here because we're coming up to this red dashed line. That's trigger number 1. Trigger number 2 is going to be if we go above the blue line. And then the final trigger that says a reversal may happen is when the line comes back down to the red dashed line again. We don't even know if that's going to happen, but we just want to watch this chart in case it does. All right, so here's a daily chart showing how we're above the 50-day moving average. You can see in Thursday and Friday session, we were below the moving average here with volume. We're positive across the board according to the Keller market model on all the different indexes. And we're positive with stocks and bonds, and we're negative with commodities and the dollar across all time frames. We're well above the midpoint of the channel here going back to 2009. This is a similar chart to the one that I showed earlier on, just looking at the long-term trend here. Then this is positive too, and I show this pretty much in every daily video too. We were able to close above this R2 pivot level, and that is pretty key. Notice how we came all the way down to this R1 level, and that was the low set in early August. And we were able to bounce up off of that and regain this pivot point. So this is still looking positive here. And then we look at the 50-period simple moving average, and this is based on 50 weeks, where price is above the red line and both are going up. That's positive. Then we do a moving average crossover with a 13-week over a 50-week moving average. We're back above the 13-week moving average again. We were able to get above that. So the S&P is looking stronger. But we haven't set an all-time high, at least yet. But still looming above. We're crossing above the midpoint here with the McClellan oscillator. So after being negative, this is turning back and looking better. And we're coming down, and we're looking extreme with the summation index here, but the fact that we're above this red line could also suggest good momentum. And we declined here based on volume, but we're also above 0. So it's still positive. The bullish percent index, and this has been holding up quite well on the daily chart and here on the weekly chart. These are the point and figure buyer sell signals inside of the S&P. And when we were going down here last week, this was holding up quite well. And I was pointing that out in the daily video. And then I was a little bit concerned because we were starting to go back up. The BPI it declined one day and barely went up another day. Well, finally on Friday, we saw this going up, and it's looking better on the daily chart, which is being confirmed here as well on the weekly chart. Okay, we're above 0 with the Swenlin trading oscillator based on price and volume. That's positive. And momentum, though, is still negative. We were starting to roll over here. The PMO is still negative. Even though we're above 0 based on price and volume, we did decline this past week. But we're seeing a bit of an improvement with the PMOs that are rising. We're still declining with the buy signals, where we're going up on the daily chart. And we're coming down here with the PMOs above 0, where that's starting to turn up on the daily chart. And we're above the midpoint with the Bollinger Bands, not showing an extreme reading right now, but since we're above the median, or the midpoint here, that is positive. So, but here's momentum. See how we're going down with all of these oscillators? They haven't been able to turn up, at least yet. Where we are in the process of turning over positive on the daily charts, we haven't rolled over yet with the longer term oscillators. Chicken money flow, showing some improvement on the daily chart, also looking good here on the weekly chart. The histogram is green and going up, and the moving average is going up as well. The Chaikin oscillator, which had been negative on the daily chart, switched back over and is now positive, and we're also going up here on the weekly chart. The force index is positive here, as it is on the daily chart. And for we might have overdone it here. We take this week and compare it to last week, and it looks like, wow, we saw a really big move. Where we saw a big move to the downside a week ago, now we're seeing a pretty big move to the upside here. We look at the money flow, we're still below 50, so that is negative. And we're still above 50 and going up here with the RSI based on 14 weeks. And the rate of change going back 50 weeks is going back up now. That's positive, but we're above this red line. And there are other times when we got above this, and that kind of meant we were a little exhausted at that point. We'll have to see if there'll be more follow through here. And we look at the Stochk RSI. After being extreme negative, we're starting to come out of that, but we're still below the midpoint. And we're still below the moving average here with the special K, where we continue to be positive on the daily chart. And we're getting extreme positive here with the Williams percent R. And we just crossed over positive with the vortex. We crossed over negative. Now we're crossing back over positive. We're still seeing the green line coming down and the red line going up, but this is still positive on the weekly chart here. And we're above 50 and going up with the ultimate oscillator. We're still negative with the Copic curve. We're also still negative on the daily chart. These are momentum oscillators. This and the whole list that I showed you, it takes them longer to shift. And then we fell down below this 10-week moving average. Well, we were able to get back above that this week, and that's pretty positive there. And then we're looking a little indecisive here with the Heikin Ashi. This is more of a doji type look, but we're turning black here. So this is still somewhat negative. But we're positive when we look at the Keiki chart. When it's black and pointing up, that's positive. We're positive with the Renko chart with the open blocks, and we're positive with the 3-line break. And we're switching back positive on all the daily charts of these indicators, or these chart measurement tools as well. And let's see, the ease of movement still negative, but improving on the daily chart, coming down, but still positive here on the weekly chart. We did see 3 X's drawn in here, not enough to give us a signal, but anytime you see X's, that's positive. When you see O's, that is negative. Look, and if you're a football player, you probably saw lots of these before. And we're somewhere here in the 50-day cycle. I don't put a lot of credence into this. It's just kind of interesting. And then we're looking at our other momentum study here. We're still declining a little bit here in the long term. We're going back up in the intermediate term, and we're looking positive again in the short term. And we've gone from negative to positive here with the Elder's Impulse system for the S&P on the weekly chart. And we continue to be positive with the parabolic SAR. We had switched over negative on the daily chart. Now we switched back over to positive on the daily chart, and that's being confirmed here by the weekly chart. And just looking at the different indexes, we're not back to the all-time high yet with the S&P. The mid-caps, they're doing better, but they've been just sideways bound for such a long time here. And the small caps, breakout, fallback, breakout, fallback, breakout, fallback. Not really, just doing an awful lot of treadmilling right now. And then we want to be aware of this. September is not a very good month, especially over the last number of years, going back to 2020. All the other months, they have some positive things going on, but not September. The Dow is positive, above its 13-week moving average, not quite back to an all-time high yet, but still positive here. The NASDAQ just barely above the blue moving average here. It was able to recapture its 50-day on the daily chart, and the fact that it's above the 13-week here, that is positive. We're seeing that same thing, just a little bit above the 13-week moving average here with the NASDAQ 100 after it had lost that, and it is above its 50-day moving average on the daily charts. So after seeing a couple of red candles here, we're seeing a white candle, and that's obviously more positive. Okay, I just want to make sure. And with the mid caps above the moving average, but you see how we're not, just awful lot of up and down, up and down, up and down, with not really going anywhere. And the small caps, kind of the same thing. Is this the breakout we've been waiting for? We've said that, what, 1, 2, 3, at least 5, 6 times this year, and it always leads to disappointment. This is a daily chart of the Wilshire 5000. We were able to get back above the 50-day moving average, and we're not at an all-time high, but we are looking better here. And the NYSE just coming off of setting a recent all-time high and still looking quite positive there. All stocks above the moving average looking much better. The big software companies also looking positive for right now. The FANG index coming right back up to this 13-week moving average and dealing with its 50-day moving average on the daily charts. And ARC, it's a downtrend. It was up 10% this week, but it's just been a real disappointment for folks. And here's the banks. This is a weekly chart. We want to keep an eye on this to see how well this is holding up. So far, looking pretty good. Even on a momentum basis, we're negative, but we're still above the midpoint here with the RSI. And money's going into banks. I just look at this to show that there's confidence in the banks. People wouldn't be putting their money into them if they thought it was going to get sucked down a hole and never come back. And then this is a weekly chart of Dow theory, where we're just coming off of a recent all-time high here, but we haven't set a new one this week with the Dow. But the transports just going sideways here. But a lot of the strength has been coming from utilities. And as I explained earlier, is this something to be concerned about? And looking at some other markets here, these are commodities, we've crossed over to a negative trend on the daily chart. And watch the intermarket analysis video for that. Here on the weekly chart, we're seeing a death cross here. And oil is still below 70. We're watching this mainly for geopolitical reasons. Silver hasn't set a new all-time high yet, but is in an uptrend, where gold is starting to break out. Now, I look at the ETF for gold. There's the futures contract and the continuous versions of that. I don't follow all that. I just use the gold ETF as a proxy for gold. And we look at copper coming down to the moving averages, trying to bounce back up. Now, if this continues to fall, that's suggesting a weaker economy going forward. If this starts to go back up, and we were up almost 4% this week, that suggests that the economy is still looking okay. And it's really indecisive right now. Then we look at the dollar, which is in a downtrend, not only on the daily chart, but here on the weekly chart as well. And that could actually be positive for stocks. Then we look at bonds here. They're just screaming to the upside, doing really well based on price, but we're rolling over a little bit here. We haven't fallen apart. This is a monthly chart of a stock to bond ratio. Yeah, we're seeing some weakness. The bonds have been outperforming stocks, but we're not necessarily falling apart, at least yet, on a longer term basis. This is a daily chart of the yields, how we've been just coming down something fierce here lately. And this is a weekly chart looking internationally. We're falling pretty much across the board here with the US, UK, Japan, and Germany. And then some relative studies. First, we look at an intermarket analysis chart where gold is doing the best, followed by the dollar. Oil is kind of in third place right now. The green is the dollar. And then they're kind of all around each other. The blue, that's the price of bonds. They had been negative for most of the year, just recently going positive year to date. We look at a ratio between the S&P 100 and the S&P 500. This is bouncing back up a little bit, but the S&P 100 had really been outperforming. Then we started to get a little bit concerned here. We're going to be watching this to see if it improves. It's the big stocks in the S&P 100 that help the S&P 500 go higher, or if they're weaker, it helps the S&P go lower. We look at a ratio between the NASDAQ 100 and the S&P, where the NASDAQ 100 has been underperforming. To say that another way, the S&P is starting to outperform, but we're not quite ready to see a death cross here on the weekly chart. We look at growth of value. Growth is buy low, sell high. Value is when the market's going to fall apart, because there's a lot of managers out there that have to be fully invested all the time. They can't go into cash like you or I can as individual investors. So they get into the stocks that'll do the least amount of damage. And those tend to be value stocks if, in fact, we're seeing some problems coming out. And we were going up nicely here with growth, but then falling back, we came right down to the moving average here, and we're bouncing back up. So growth is showing some improvement longer term. And we look at a gold ratio to the S&P 500, not anything all that spectacular, because both have been doing quite well. Gold to the dollar, where gold is outperforming the dollar as gold's been going up and the dollar's been going down. We look at bonds, where we were starting to come up, and that was giving us a little cause of concern a week ago. Now it's starting to come back down here on the weekly chart. And we look at the low volatility stocks. These are more defensive. and then compare them to the S&P 500, where they were starting to come up, but now they're starting to come back down. And longer term, they've been underperforming as the market's been going up. We look at a ratio between energy and tech. When this is going down, that means energy is underperforming, and that's still continuing now. Discretionary to staples, we want discretionary to do better, but it's in a downtrend when compared to staples longer term. And we look at a weekly chart here, small caps to tech. This was starting to go up, but now starting to come back down as the tech sector is outperforming small caps. Then some long-term charts here, just the NYSE breadth thrust, still looking solid. This is like indefinitely on the books here. We set this low back in October 2022, and that's what we've been working off of ever since then. And then this is the ZWAG NYSE breadth thrust. No recent signals have been triggered here. And this is what happens when a signal is triggered with the ZWAG NYSE breadth thrust. And going out 12 months, it's got a perfect track record. And we look at a long-term chart going back to the 1987 crash with the S&P on a weekly basis. Still looking really solid here. This is a blow up of that same chart, still well above this trend line. We're still on a full-on Zahorchak buy signal. That's also very long-term. And we look at a 50-period moving average of the new highs minus the new lows for the S&P. We're still coming down a little bit as it was seeing some weakness. We would like to see this turn and go back up to be more positive. And we look at the NYSE new highs minus the new lows. These are going up. This is also a 50-week moving 50-period moving average, which would be, no, this is a daily chart. Excuse me. This going up is just showing how the broader market is hanging in there pretty solid. And we look at the NASDAQ 100, a weekly chart. We're back slightly above this trend line going back to 2009. And we look at a ratio between the NASDAQ 100 and the Dow. We're right back to these high levels that we were at before. So nothing's really falling apart now. And we look at another ratio of the NASDAQ 100 to small caps. Still right around these high levels, not showing any real weakness, at least yet. Then this is a daily chart of the cumulative new highs, new lows for the NASDAQ. We're pretty much flat. On the bottom is a daily score. And when we're above zero, we are positive. Now, this isn't something that we want to pay attention to. This is the 3-month yield. And it's really coming down big time here. You notice how this happened in 2007 into 2008? We don't know if it's going to play out this way, but this is what happened before. So we just want to be aware of this time. We're not declaring anything by this chart. We're going to let other things tell us what's actually going on. But the fact that this is really coming down, and it did happen then before the great financial crisis, we just want to be aware of this. And then we have this thing called the Hindenburg-Ullman. If you want to know more about it, pause this and read through all this stuff. There's 3 criteria that have to come together for a Hindenburg-Ullman to be triggered. And what the nice thing about it is that stockcharts.com has one indicator that takes all those criteria and puts them together. We've had a confirmation now. And you see back in 2020, this is right before the COVID crash. And this is the end of 2021. And then see, we went through 2022 after that. Well, we were getting spikes along the way here, but no confirmations. You have to have 2 of these spikes within 20 trading days of each other. And this was confirmed on the 12th of September. Now, is it going to play out this way? We don't know. The perma bears are just partying like there's no tomorrow because they're sure we're falling off a cliff. That might happen. It's happened before, but we don't just, excuse me, we don't use this chart in isolation. They do, but I don't. And so, okay, we're aware of this. We respect it. We'll look at other things and see how things come together. I would suggest watching the daily videos if you see the index is starting to weaken, and we'll just adjust accordingly. All right, then seasonality, and here's a new one here. This could really go on the daily video here. It's just what days of the week tend to be positive. Now, all the days of the week are recently positive, but this goes back to 1928 and says, yeah, no wonder I don't like Monday, if you remember that song. I don't like Mondays. All right, and then this is historically a weaker time. This red box here, this is September going into October, and then we see some typical weakness after that. Is that going to happen this time? We don't know, but it typically has happened in the past. When September is usually quite a weak month here, going back to 1950, and then September also weak here. We also weak after we saw a good June, July, and August. And then here's September and October together showing negative returns. And then the first part of September does okay. It's the second part of September where things tend to really fall apart. And we're getting close to that middle part now. So we want to be aware of what's going on a seasonal basis. And then this also looks at September and October and shows negative returns. This way, this looks at the NASDAQ and S&P together. Negative in September, negative in October. And then here's another. People say, why do you show so many charts? It's like, well, do you see a little confirmation going on here? These are different companies putting out different charts using slightly different data, and they're all reaching the same conclusion. So yeah, we want to pay attention to that. Here's another one, August through October, also negative returns for that 3-month period. This is a new one here, taking what we've done so far year to date in 2024, and then comparing it when we don't have an election versus when we do have an election. And we see some weakness right about now, historically. But then when you look at 1950 up till now during an election year, we're 9 for 9. So we're 50% here, with the usual return being a negative 0.4%. Thank you. I really hope you found this helpful. I hope you're having a nice weekend. Well, by the time you see this, the weekend might be over. But have a really good weekend, or I hope you had a good weekend, and I will talk to you in the next video.